What is up, everybody? Welcome back. This is episode 10 of the Fresh Finance podcast. This is Thomas Elms. I got my co-host here, Kyle Ryan, on with me. Today, we are going to talk about how to analyze your portfolio. I think that this is a really important conversation to start having, especially because as of right now, we've seen a pretty heavy correction in the markets. There's a lot of different talking points going on in the market and in a lot of people's portfolios right now. And so Kyle and I just kind of wanted to talk through a couple of things that we're typically looking at when we're analyzing portfolios of current clients, but also at analyzing portfolio of prospective clients that are maybe coming in, looking to get a second look and possibly at the opportunity to work with us. So, Kyle, just kind of want to break this down into three topics here and we'll kind of walk through each one. But the way that we tend to analyze portfolios is we want to look at equities, we want to look at fixed income, and we want to look at expectations. And so if you could, I'd really just kind of like to get your base intro into this conversation of the equity piece, kind of talking about growth value, and some of the more general things that you'll look at when you're helping a client analyze their portfolio.
Yeah, thank you, Thomas. I think now's, a really good time for clients to have an idea and an understanding of the different investments they're in, because, whether you are in a growth stock versus a value stock could be a significant determination of your performance this year.
Absolutely.
Growth is very, very much undervalued or underperformed value stocks. And, we think it would be a good idea for people to understand, one, what is a growth stock? What's a value stock? And when do they tend to perform better? So, growth stocks as a whole are typically, growth investors are looking for companies that have strong earnings growth, right? Right there in the name. Companies that can invest in themselves, that can basically trade at higher levels than their current PE ratio, right? So these companies typically will have lofty valuations because consumers and investors are expecting that they're going to grow at an extraordinary rate. Value companies, on the other hand, are typically, investors are looking for undervalued companies. These companies aren't going to be growing at that 30% clip, more than likely that, some of these technology firms might, but these ones are typically, companies that'll give you a solid dividend, really strong balance sheets, and a lot more quality kind of in that name. So, just kind of having an understanding of growth versus value stocks from the 30,000 foot view, it's really good to know where you're at and, understanding how they are impacted by various things that could happen in the market. Like, who knows, rising interest rates or inflation. We think it'd be a great idea to cover that. So feel free to, dive in further there.
Yeah, one of the things that I was going to kind of hit on some napkin, finance topic here is normally growth is the more aggressive route of investing, and value is traditionally more of the conservative route to investing, because normally your value companies are going to be your quote unquote your blue chippers that aren't going to have very much price fluctuation within a year. They normally have a lot of cash flow or a lot of cash on hand. They're paying good dividends. And they're kind of that stable company. And one of the interesting things I think that especially we've seen this month is the retail sector, right? I'm not going to name any names for compliance purposes, but there's a couple of companies in the retail sector that have kind of been the backbone of this market. And they put out bad earnings, this past quarter, and they really got pummeled. And so this is kind of one of the first times during what we would consider kind of like a correctionary or even maybe a recessionary period where value is actually getting hit really hard. And I think the majority of that is coming from, we're seeing a lot of supply chain issues that is essentially preventing them from having the revenue or the production that they're used to having, regardless of, whether we're in a correctionary environment or not. And so that's kind of one of the unique things that I would say kind of about this specific market environment in relation to its others is normally the value positions were kind of those bedrock positions that you could go to and down markets, things that are going to be defensive with you. And there's just really a lot of those that are getting exposed right now, whether they like it or not. And so it really just kind of presents this idea that in different markets, it's going to span different winners and losers. And there's no guarantee that, your value performers aren't always going to just come to save you, regardless of market situation. And, so I think that that's super important to look at. What about the bond side? Is there anything in particular that you guys are looking at, kind of hitting out the buzzwords like duration, hitting at the buzzwords of yield versus total return? Is that something that you guys are talking about?
Yeah, the bond world has been particularly frustrating this year because,
100%.
just even, talking about stocks and bonds in general, typically they are acting conversely with an inverse relationship with one another. Whereas stocks are doing well, people are selling their bonds to buy stocks.
Yeah.
If stocks are doing poorly, people are selling their stocks to buy bonds. So they typically have an inverse relationship, but we all love a year when they're both down, right?
Exactly.
So
Right.
it really has to do with, a risk off attitude around the world from investors. But, to kind of dig into bonds and understanding them, depending on the type of bond you're in, really is, again, determining your performance this year. In terms duration, what's duration? Duration is how long it takes for you to get your coupon or get back to par on your bond, right? So if you have a really, really long duration bond, say 30 years, it's going to take you 30 years to recoup your payments. And in the face of an inflationary and a rising interest rate environment, you're really going to start losing, your value there. Especially as, those expectations get priced in, whereas short duration bonds are typically a little bit safer. And you've seen that in returns this year. And even further beyond that, you get quality. What's quality? How healthy of a financial position the bond issuer is that's, issuing the bond essentially. So if you have a huge company that has a very strong balance sheet, a lot of cash on hand, and they issue a bond, they're not going to pay investors to take the risk as much as other companies that have, a riskier bond. Maybe they don't have as great of an outlook. Maybe they don't have as strong of a balance sheet or the ability to cover that bond. They'll offer you a higher payout. So right now, these high quality bonds from these stronger companies, they're holding up better than, riskier bonds, the high yield bonds of the world that, you're taking more risk for more reward. And right now that risk is eating it more.
Yeah, for sure. And I think that's kind of like the positive outlook on the future, is a lot of people are in a position where they're forced to be in equities because bonds just are at a point right now where they're not performing well. And in that mindset, you want to get away from something from a return to risk perspective that's off. And I know we'll talk about return and risk here in a bit, but I think down the line, since we're kind of in this correctionary mode of moving rates up, I think it's going to increase yield possibly over the next, I would say probably 5 to 10 years. And I think it's going to make a really great positive move for the bond market. And I think it's going to make investing a lot easier for people here, at least in the short to midterm. After this event has finished and already taken place, because the equity risk premium right now is just off the charts. And that's a really important conversation to have, because equity risk premium is essentially the amount of risk you need to take when getting into equities. And the main reason why the premium is so high right now is because bonds are just getting smacked. I was looking at the Bloomberg Barclays bond index year to date, it's down 10%. I mean, find me another year when the bond index was down 10%, not even halfway through the year. It's just, this has just been such an interesting market, for the past 6 to 8 months. And just, I don't think really anybody expected it. I think people just thought that we were going to come out of this second wave of COVID and do exactly what we did after the first wave, is we were just going to rally to no end, and we were just going to keep levering up the system. But inflation came a knocking right around May of 21, and that's going to be another important and key stat, I think, coming out next month is the actual year over year number on what inflation looks like. Because our research, our analysis shows that the market's already priced in all the rate hikes, but inflation is kind of that key number that we're really curious about.
Yeah, there's a lot of volatility out there, and honestly, everything that I'm seeing is the market needed this correction. We just had a historic, a very long bull run, 10 years where the market just kept going up and up and up, and we reached this valuation where it had to give, and before the start of this year, the market was priced to perfection. Nothing could go wrong in order to keep the valuations we were at. And then you throw in geopolitical uncertainty, Russia invades Ukraine, you throw in crazy inflation numbers that people didn't foresee coming, and therefore rising interest rates. It makes it, very difficult.
Oh yeah.
But again, it's a positive thing. We just face the damage. The markets are kind of back to historical averages of valuations. And even going back to the bond side, how bonds work, I always love the seesaw analogy, right? So how bonds work is if your price goes down, the value of your bonds goes down. It's like a seesaw. The yield of your bonds will go up, right? So in rising interest rates, your bonds value is going to go down, but you're going to get more income from those bonds. Conversely, when interest rates are falling, the value of your bonds is going to go up. You're just going to get less yield from them.
Yeah.
And I think that'd be a good, time to talk about what is yield and how does it play into total return? Because, I know we've both had very interesting stories where, you have someone who has an investment that's yielding 5%. They love it. They never want to get rid of their 5% dividend, but it's just simply an investment that's not doing well right now.
Yeah.
If it goes down 10% and it's yielding 5%, you're still net down no matter what it's giving you, right?
Exactly.
Shake that off.
Yeah. Yeah. And that's where value investing can actually be a little bit harder. Because if you just pick a growth name, like that's all you need to focus on is you need to focus on price appreciation. Do they have opportunities for growth? And, and the secondary side of the value conversation is, does this company have enough cash or cash flow or cash on hand to provide a good dividend that's worth investing in? But also, do they have enough value in the service or the goods that they provide to either stay within a relative range that's, in a positive direction, or do they have the ability to move upwards and appreciate in price and grow? Because, the dividend is like the little thing that somebody will dangle in front of you to steal the thing, steal your wallet out of your pocket. Right. And I just made that analogy up just right on the spot. And I actually really like that because I think that that's what happens with investors is there's this dividend that's just kind of like dangling in front of them that they just have their eyes completely focused on. It's like, oh, this company pays a 7% dividend, and then when you look at their trailing 12-month return and they're down, 14%, it's like, yeah, you got this 7% dividend, but you're still down, total 7%. And it's just really balancing the idea of, can we find good dividend paying companies that also have a good forward looking growth opportunities that are going to provide for price appreciation as well? Because the higher that price goes, as long as the dividend remains the same, the more you're going to get per year. And so I think that there's a lot of value in recognizing that dividend yield or bond yield is not the only thing you want to look at. It's the total return of that individual position within both the price and in the yield.
Yeah. And, it's funny because I can think of multiple companies off the top of my head that, they always promise to grow their dividend. They will never cut their dividend. They only grow it. Well, if you don't have the cash flow or the ability to actually fund that, and you just continually grow it because you don't want investors to jump ship because they see that you cut your dividend, you're putting yourself into a pretty, difficult financial situation as a company. And, investors ought to be aware of that. What companies are simply growing their dividend because they're actually good, strong companies and can afford to do so, versus what ones are doing that so that, the red flag doesn't wave and all of a sudden they're cutting their dividend. Oh my God, we have to jump ship. So, just again, taking a deeper look at the company and why they're why they're raising their dividend. Can they afford it? It's incredibly important to know.
Oh yeah. And there's a specific company that I think that's case in point that I won't manage, but it's a very well-known company in the telecommunications sector.
I know it.
And the thing that they've been doing, and they're kind of dangling this carrot, like, I was talking about dangling this trinket, is their prices going down and they're increasing their quote unquote yield percentage. Right. So they're basically paying out what would be similar if they were moving upwards in price, but their price is going down and they're increasing their yield. Because one of the things that I think there are so many investors that will run into this issue, that they will look past this issue, is you actually want to be really worried about a company that's paying a huge dividend, because it's normally either not going to last or is something that they can't sustain. And they're trying to do it for a short-term purpose to reel you in, and then they're going to drop it, and then you're kind of stuck with this position. Right. And so like there's a lot of different companies out there that are trying to reel you in with the dividend so you can buy shares of their company so that they can receive capital as a short-term fix. And so there's a lot of conversation about that too.
I know exactly where your mind went when you were talking about that. That's the
Yeah.
first one that came to my head too.
Yeah.
It's so funny. Just to give it another example, if you have a company that's worth $100 and they're giving you a $10 dividend a year, that's 10%. That's beautiful. Well, if they go down to $50, if they get cut in half and they're still maintaining that $10 dividend, oh my gosh, their yield is 20%. That's amazing. And some people are just like, oh wow, the yield keeps going up. Why would you want to sell it? It's like there's a good reason that yield is going up.
Yeah, exactly. So there's we could be talking growth versus value and yield versus total return all day. And I think it kind of moves into this last part of expectations. And I think that for us, and you and I have talked about this offline a couple of times, but for us this past 12 months, we have learned more about setting expectations than I'm pretty sure I ever really expected to understand about setting expectations. Is truly, as you're building out a portfolio, whether you're doing it yourself or whether you're doing it with an advisor, is truly building out the right set of goals and expectations based off of your risk capacity and your goals. I would say those are the two things that are going to really underline what your overall strategy is going to look like, what your makeup of equities and fixed income is going to look like, and what your possible returns and outlying risks are. Because one of the things that I think, and echo this if you feel the same way, but we've got a lot of retail investors who think that they can just put money into the market and it's going to go up more than it's going to go down almost all the time. And there is a shade of truth to that. But I think this is one of the interesting times in the market because a lot of people have heard this philosophy that just putting money into an index fund is easily, the number one route of investing. And there is some possible truth to that if your risk capacity is really high. Right. Because a lot of people, at least from what I've run into recently with people reaching out for advice and guidance and maybe a recorrection of their risk capacity, is they thought that was a product that couldn't go down 20% in 6 months. Right. Because, the S&P is down right at about 18-19% year to date right now. And a lot of people just don't have the capacity to handle that risk. Now, there's a flip side to that. If you can't handle an 18 to 19% decline in a given year, then you also don't get to participate in an 18 to 19% positive year on the upside. And I think that's one of the biggest disconnects on the investing piece. Is the way that I personally think about it is you need to have a one-to-one approach when it comes to risk capacity. Every 1% that you're okay with the upside, that you're looking for on the upside, you need to be okay with the same 1% on the downside. So and normally you have to kind of work in the opposite direction to find this out, but if you're only comfortable with receiving 10% downside, it's obviously not a guarantee that we can just mitigate it to 10%. But if that's the only thing you're comfortable with, that is the max return you should be comfortable with on the upside. And then as we build out 20%, 15, 20, 30, that's a good measure of risk capacity, in my opinion.
Yeah, I think it's a good measured approach. And you can also take that same example and go, really warn clients about the value of the sequence of returns, because if you have someone who's like, look, I need to make 10% of my money within this next year. Well, look, if you go down 10%,
100%.
Let's say you go down 20%, right? You go down 20% on your money. You have to make more than 20% to get back to even. If you have $100,000 and you go down 20%, you're at 80,000. You need 25% to get back. So, taking, your own risk and your time horizon and, what you're willing to give to get is all, really incredibly points. And Thomas, I think I know what every investor wants to invest in. It's the investment that has the highest return and the lowest amount of risk. That's all you got to do. You just got to find that one, right?
Easy, dude.
Yeah.
it's find something that's going to get me 10% every year and never goes down.
Yep.
And I'm looking for I've got some notes on something that was kind of acknowledging those ranges of returns. I'm gonna see if I can find it. If you can just give me like 5 seconds here. It doesn't look like I'm gonna find it, and I can't find it. No need to waste time. But it was really interesting. It was kind of a guide to the markets. Is actually from JP Morgan, and it was essentially showing between equities, bonds, and cash what the 1 year, 3 year, 5 year, 10 year, 20 year range of returns look like. And it was really interesting because obviously, like you were talking about, that 1 year range on equities is which is basically the only place that you can traditionally get 10% in a given year, especially right now. And the 1 year range was insane. But yeah, so, kind of to sum it all up, really finding firstly, when you're analyzing a portfolio, making sure that your capacity for risk in relationship to its return is something that meets your risk capacity and your goals and objectives, I think is important, because that's going to help you kind of outline, okay, if I can, withstand a 20% decline, then that means that I am comfortable with the majority of my portfolio being in the market, being in equities. But if you're somebody who's only kind of in the 10 to 15% gap, then we need to start talking about having fixed income. And so there's a portion there, and that's going to help you kind of build out that equity profile. It's going to help you build out your fixed income profile. And I think that we could even maybe have some conversations down the line about an episode where we're kind of having a conversation between baskets and individuals, where we're talking about baskets on the equity side and baskets on the fixed income side versus individuals on the equity and fixed income side. And what I mean by that is funds versus individual positions, because I think that there's pros and cons to that, for sure, whether you're owning a bond mutual fund or a bond ETF versus an individual bond. I think that could definitely be a good video to put together as well.
Yep. Yeah. I would just encourage everyone, the amount of times that I've, looked at a 401k, looked at an IRA, and, it's someone who is very risk averse, approaching retirement. And they think, they're in safe stuff, hey, my portfolio has performed really well these last 3 years and now it's getting hurt. And you take a look under the hood and it's 100% in, the S&P 500, or it's 100% in technology stocks. And it's like, well, this doesn't exactly suit your risk tolerance. So I encourage anyone listening or viewing this to go, take a look at your 401k, take a look at your IRA, take a look at your investments, and ask yourself, what do you want out of this? What do you want this year? How safe do you want to be? How aggressive do you want to be? And do your investments fit your risk tolerance?
For sure. Yep. Love it. Just kind of wrapping up here. Next episode is going to be a market update. So make sure you guys are paying attention for when that drops. Make sure you're subscribed if you aren't. And look forward to getting that next video out. Hopefully we got some good numbers coming into that video, and we can touch base on those.
Great. Always a pleasure, Thomas.
Perfect. Thank you, sir. Thanks for watching. Appreciate you guys listening, and we'll catch you next week.